What's going on, guys? How are you? How are you doing? How is your trading? So my name is Shocks, and this is ShocksCapital FX YouTube channel. If you're new to this channel, we talk about everything to do with derivative indices, everything to do with forex trading, institutional trading, and ICT and smart money concepts. So today we want to talk about boom and crash, and we are going to be using the Crash300 to explain everything that we're going to explain here, and we are going to give away a Crash300 strategy that you can go and use in your trading. So this strategy catches spikes and it also does go for ticks. So what we're going to do here is to understand the high of the day or the low of the day, then wait for breakout structure and wait for that retest. So what we're just going to do is very simple. I want you to zoom in this picture that I have. So we have these period separators. For those ones of you who don't know how to put these period separators, this is how you do it. You right click, then you go to properties, you go to show here, then you just click here, show period separators. Okay, that will be done. Right. So what I want to show you is this is the high of the day logged in. As you can see, this is the high of the day. So what do you wait for? You wait for break of structure like this, the break of the next low. When this breaks, this is Crash300. And remember, if you are going for sales, it means we are catching spikes. So when this breaks, price retests this, you are entering at this particular point, and this is your trade. Your next TP is the next low, which is this one, and you are going to take a profit at that particular point. And remember, this is on the M15 time frame. So what you just do is wait for the high of the day or the low of the day to be logged in. After it is logged in, you just wait for what? You just wait for retest, then you can get your trade. And remember, you don't just get your trade, you wait for confirmations. And the confirmation that you're waiting for, number one, is the pin. Number two is the railroad track. Number three is the engulfing candle. So the reason why we don't use the M1 is because you can't really tell what is the pin or what is the engulfing candle in a situation like this or on a chart that looks like this. So you go on the M15 and try to see the chart patterns or the chart formations that I'm talking about. So remember, this is the breakout structure. Price breaks, right, and retest. And where is your candle formation? You see, this is the green candle here. We have pins and we also have the engulfing candle, as you can see in this chart. So this would be your position of entry, and the stop loss goes above this candlestick formation, as you can see. So if you go further, you can see that these are patterns that occur frequently. So this is this is high of the day, break of structure, retest. The retest came here, but remember, you're not getting involved here. You're getting involved after this pin. So where is your trade or where is your entry? Your entry is here, and your stop loss is going above the formation, and this is how this trade would have worked out. But I want you to see something, that this is the next day. It's not the day that this formation formed, right? It's not the same day as the setup. So you would want setups that form on that particular day. If you have a break of structure or a break of structure or a break of that neckline that forms the high of the day or the low of the day, you need the retest to be on the same day. Remember, we have high of the day logged in, we have break of structure at this particular point. This is the retest. And what is your candlestick formation? Engulfing candle at this particular point. Where is your take profit? Next low, and this would be your trade, as you can see. So let's just go and look at the other direction, which is the tick side, right? So this was how you catch spikes. So let's look at the tick side of the thing. So in this case, you are looking for the low of the day. So this is the low of the day, as you can see on this particular day. This was the 28th of November, right? So we break that structure, break the structure. Where's the retest? There we retest at this particular point. Either you took this or this, no problem, right? It depends on what you are preferring as a trader. I would have taken this. Why? Because we have a tweezer formation here where we have these two hammers facing the same direction but different color. So this is the tweezer formation. Or if you taken this one, this would be the pin bar formation, and the stop loss goes up below this formation, right? So this would be your trade. You take it, you go up, right? Take it, you go up. This would be your trade, and your stop loss is going below the candlestick formation. You come here again. What do you see from this? This is the low of the day, and the breakout structure happens at this particular point. breakout structure, retest, and the retest, it's not okay here, but as you can see, we have 3 soldiers here, so you could have taken your trade at this particular point, right? And your stop loss, where is it going? It's going below here, and as you can see, the stop loss would have been taken here at this particular point. The stop loss would have been taken, and would have lost this trade. Again, let's look at the next day. What do you see? This is the what? This is the low, right? This is the low that you are seeing. Remember, the high of the day is this one. So first of all, this was supposed to be the high of the day, but did not break structure. So we extended that high of the day with this one, with this leg, and after extending, we had a new what? A new low. And where is that low of yours? This low of yours is here at this particular point. And what do? We break that. After breaking, we retest, and after retesting, what do? You look closely, you see that we have this engulfing candle that breaks there. So if this is too long, you wait for price to retrace maybe to 50% of that candle, then you enter here at this particular point. So I hope you're writing down these rules, right? Because I'm just mentioning them as I go. So the 50% of this candlestick is here, so you just wait for price to retrace a bit, and you can get a better entry. And remember, your stop loss is just going above this what? Above this formation right here. So price took time to move here, and it eventually did move in a direction, and they've taken your profit at this particular point. So this is how you look at it, both when you want to catch spikes and when you want to catch ticks, right? So this is a tick formation, and this is a tick setup example that I'm going to show you again here. What do you see? You have breakout structure to the upside, then you have price retesting this with a what? With a pin bar. So this pin bar that you are seeing is your what? Is your trade. And where are you going? Your TP is supposed to be here, where are you having that high. So when you enter here, where is your stop loss? Your stop loss going just below the pin bar. You get your entry here, and you are going on like that. So this is how you trade Crash300. It doesn't matter if you want to catch spikes, if you want to catch ticks, if you're a tick trader, if you are a spike trader, the thinking or the setup is the same. Remember, here we have breakout structure, price comes and gives you a pin. So the pin bar is the last confirmation that you need when you are trading like this. So pin bar, what do? You go and set your stop loss just below the formation. And what are you going to target? You are going to target the next high or the following high. So it depends. So if you get in here, you are going up like that. So this is how you trade boom and crash, and this is how you trade Crash300. I hope, guys, this was helpful, and I seriously hope that you are going to test this out on your MT5 and trade like a boss. I will see you in the next video.